Hello and welcome. I'm Christine Zhou reporting for ATF TV from London. Today we are pleased to welcome Shubhada Rao to ATF TV. Shubhada joins us from Mumbai and is the founder of economic advisory firm QuantEco Research. Today she will discuss the recent steps taken by the Indian government to develop the country's finance institutions and its national infrastructure. Shubhada, welcome to ATF TV.
Pleasure, Christine. It's indeed a pleasure joining you.
Shubhada, this week, India has introduced a development finance institution bill, which is expected to create a lending portfolio of at least 70 billion US dollars in 3 years. What is the rationale here, and how does it fit into the government's plan to boost infrastructure investment to lift the economy out of the COVID slowdown?
I think India has, in recent years, showcased its infrastructure deficit rather well. So be it ports, be it roads, aviation, all the physical hard infrastructure has seriously needed large dose of investment, and it has been identified. While amongst the different sectors, the road projects has been on a relative scale doing far better, but clearly India needed huge dose of investment. So there was an absolute need for creation of a new long-term financing institution, given the gestation, given the risk parameters, and so on. So that's how the rationale for once again revisiting the creation of a development financial institution, which incidentally last week did see a final formal approval called the National Bank for Financing and Development. Now, the reason was, to make good of the gap that the commercial banks were unable to fit in to finance the long-term projects.
Shubhada, India's long-term infrastructure financing needs are well documented, with limited appetite amongst commercial lenders for infrastructure financing. What are the specific needs this latest bill will help to fulfill to ensure it doesn't meet the fate of its predecessors, which evolved from government to commercial lenders?
Well, that's a great question, Christine, because that gets asked often in terms of why this sudden need for a new development financial institution, particularly knowing what happened to the earlier three, essentially, that got created in late 40s to right up to early 60s. The important point was the earlier financial institutions, the long-term financial institutions, were able to avail of concessional funding through the government, through the multilateral institutions, and as such, their cost of fundings was very low. And that's how they were able to on-lend to the projects at a lower cost. However, since 1991, when India unleashed its broad-based, very significant reforms, including the financial reforms, there has been a difficulty for those development financial institutions to raise money at a very cheap rate. And that's how most of them either folded up or reverse merged themselves into converting into a full-fledged universal commercial bank. And that's how a lot of infrastructure funding since then, from mid-1990s, was getting funded through commercial banks by a large measure. And of course, a few multilateral and international development institutions. But there was still a huge gap for the domestic long-term financial institution that needed to get bridged. Clearly, we are unlikely to see a whole story of very cheap funding available. We will have to somewhere align ourselves to the market rates, but nevertheless, we have to tie up with long-term institutions. So one, there is limited asset liability mismatch. Two, when these long-term institutions, they understand the whole structure better. And even if the rate of return is 10% plus, I think it should make a very attractive investment for the global investors to invest into this DFI. As I said, over the next few years, the government is going to reduce its stake to 26%. The initial capital is going to be put in by the government of India.
Shubhada, infrastructure projects typically need long duration, low-cost funding, and most importantly, significant expertise in risk analysis and sophisticated capital markets. What are the lessons from the past that this institution will bring to the table?
I think it's going to be imperative to have a kind of an independent board, which incidentally the government and the Ministry of Finance has already indicated. It's going to be a professionally run board, and the selection of the committees are going to be made by the central bank, the Reserve Bank of India, getting and putting in place a team that understands these infrastructure sectors better. They have technical expertise to be able to evaluate the risk return profile, the risk parameters that are involved in each of those infrastructure projects, be it in roads or ports or railways or urban logistics or water and sanitation and so on. So the essential need is going to be to get the right personnel, to have an independent evaluation office that makes the assessment of the risk profile of those projects. Of course, it's also going to be equally important that the primary initial risk is borne by the government,